Reddit is dead wrong about covered call ETFs. I spent a lot of time reading these threads not to argue with strangers on Reddit, but because if you're holding funds like JEPI, JEPQ, SPY-I, GPIQ, you deserve to know which of these criticisms are actually real. And some of them might be. Almost every myth I'm about to go through has a kernel of truth buried somewhere in it. But here's the problem. Reddit doesn't deal in kernels, it deals in absolutes. A partial truth or misguided truth, if it gets repeated enough times, it turns into gospel. And that's exactly where it stops being useful to you. So I pulled a few of the most repeated ones I've seen. Not to defend these funds, that's not what I'm doing. It's just so that you can tell the difference between a real risk and a rumor that got out of hand before you decide whether one of these belongs in your portfolio. By the way, if you're new to this channel, I wanted to welcome you. My focus is strictly on covered call and income ETFs. So if that's of interest to you, make sure to hit the like and subscribe button. My background, educationally, I have a degree in engineering, and I used to work in the investment research side of the hedge fund industry. So I will be able to give you a pretty mechanical perspective, very analytical when it comes to uncovering what these funds are all about. And having said that, I do want to put out a disclaimer, and that is that the information I'm going to be presenting to you is for education only, not meant as financial or tax advice. So please always consult with a licensed financial and tax professional before you make any investment decisions. And also note that past results are not a guarantee of future ones. So here is the first one from Reddit. I've heard from multiple people that JEPQ is a bad investment because it caps, quote unquote, your growth, while in a crash it feels the full extent of it. So first of all, apologies for the misspellings, just copying this straight from Reddit. And we can substitute JEPQ for a number of covered call ETFs. Or income ETFs. They just happen to mention JEPQ in this example. So let's tackle what they're talking about in that it caps your growth, and while in a crash, it's going to feel the full extent of it. So this is actually one that does have some truth to it, because by definition, a covered call ETF or an income ETF is designed to cap your growth somewhat. And they're actually serving different purposes. It would be similar to you comparing an SUV to a sports car. The comparison would be silly because sports car is optimized for maximum speed and acceleration. And in a powerful bull market, getting back to the ETFs, it should pull ahead. A covered call ETF would be like an SUV. It still has powerful base engine, but it's engineered for more utility, i.e. monthly income and a potential smoother ride. So they're actually serving different purposes. If you're seeking retirement income, if you're seeking some extra income to complement your salary, I think a covered call ETF or income ETF is a phenomenal investment because of that. And it's definitely not a bad investment at all. Now, if you're in your 20s and you're looking for the maximum growth, sure, there will be an argument for you to perhaps not invest in a covered call ETF, because at this stage in your early 20s or mid 20s, you're looking for the maximum growth and you have a lot of time for that to occur. But if you're in retirement age, or you're even in middle age and still working, and you're looking to generate extra income or augment your salary, then a covered call ETF may be the right vehicle for you. So they're serving different purposes. Now, the argument that Reddit made about how in a crash it's going to feel the full extent of it, yes, it's going to feel the extent of it, but not to the same degree, because remember, you're getting income. And oftentimes that distribution is going to be in the 8, 9, 10% or even higher. So if anything, it's going to be able to cushion that potential crash that you would experience. Now, here's the next one. I saw this guy on this app called Blossom with a yield of 11.36%. I thought that anything above like a 4% dividend yield is basically a yield trap. And he's getting double digits. Do you consider JEPQ or SPY-I, even triple QI by NEOS to be a real dividend, which is likely how this yield is generated, since they lose money on the options position but still pay a distribution? This Reddit post made me chuckle a little bit. People hear an 11% yield, 10% yield, 12% yield, and immediately call it a yield trap. But that actually confuses traditional dividend stocks, for example, Chevron, Coca-Cola, with option income ETFs, completely different vehicles. Looking at JEPQ, SPY-I, triple QI as an example, they're generating monthly distributions from options premiums and in some cases return of capital. Now, looking at are they real dividends? Technically, they're fund distributions, not necessarily qualified dividends, but the bottom line is the cash is real. The more important question is whether the fund produces a healthy total return while paying you that income. In covered call ETFs versus dividend growth, it's not an either or decision. Dividend growth is generally better for investors focused on maximizing long-term compounding. Covered call ETFs can be better for investors who need meaningful cash flow today and are willing to trade some future upside for it. I personally am in my 50s, so I actually invest in both. I invest in dividend growth stocks. I do have other investments. And I also believe in covered call ETFs and income ETFs as I'm trying to augment my income. So there's really no mistake in wanting to do both or focusing on one or the other. They're just different vehicles. Looking at an analogy, an SUV is not a bad vehicle, right? Because it loses to a sports car on a racetrack, still a great vehicle. It's just built for a different purpose. Income ETFs are built to deliver more usable income now, not to be triple Q at maximum speed. So here's the next one. I see comments and posts that seem to disagree on exactly what NAV erosion is. Some indicate that return of capital alone is NAV erosion. Others seem to believe that any decrease in the price of the ETF is NAV erosion. I'm curious to see what everyone thinks the definition of NAV erosion is. And what I did afterwards is I looked at this thread and I was pretty distraught at the amount of differing opinions on what NAV erosion is, yet the confidence when stating what it was, when it's really pretty simple. So I'm going to define it here for you. Take a look at this formula. So NAV erosion is the ending NAV minus the beginning NAV divided by the beginning NAV times 100. Or another way to quantify it would be, let's say you bought an ETF for $20 and at the end of the year, it finished at $15. So 15 minus 20, and you can already tell it's going to be negative, divided by 20 times 100 would be a NAV erosion of 25%. Distributions should not be added to this NAV erosion formula, although I do see it being discussed in these Reddit threads. And oftentimes when you do that, it makes a NAV erosion look like very negligible or less than what it should be. To properly assess these ETFs, it's really important to follow this NAV erosion formula and really separate out the distributions. Now, a lot of covered call ETFs, a lot of income ETFs do have pretty significant NAV erosion. I'm not going to lie to you. So that's one part of the assessment that you should be taking a look at is distributions may look phenomenal. One example would be yield max ETFs. They've been known for having really incredible distributions in the 40, 50, 60% range. But when you look at the NAV erosion, it's becoming a shrinking asset. And that's why a lot of people are becoming skeptical of these types of ETFs. And by the way, if you're interested in yield max or they caught your attention, there is actually one ETF that is the exception to this rule. I'm going to put a link to that video in the description here. And let's move on to the next Reddit thread that I saw. So in this one, which I found to be quite interesting, one of the Redditors says, If I were to make covered call myself, I consider that gambling, not investing. These funds are far safer and have more resources than I do. Then he mentions a couple of conservative funds. And there was another Redditor that agreed with them and said, I agree, they're not safe. It's a gamble for sure. You have to make sure the covered call funds are a small portion of your portfolio and offset risk by investing in growth dividend funds. So let me address this because there's definitely a misconception that it's important to set the tone in. So calling covered call ETFs as gambling is very misleading because a diversified covered call ETF is not making random bets. If you think about it, it owns a portfolio of stocks and systematically sells call options to generate income. It's very diversified. Now, the trade-off is straightforward. You do give up some upside in exchange for option premium, but that does not make it riskier than a traditional ETF. It just gives it a different profile. Now, what would be risky would be putting, let's say, 50% of your portfolio into one fund while also using margin to try to retire early. That would be more akin to gambling. That is portfolio construction decision, not proof that covered call ETFs themselves are speculative. They're not. The better question is not, is this gambling? It's, what does the fund own? How aggressive is the option strategy? And does it match the investor's need for income, growth, and risk? So I saved the best for last, and this Redditor is asking, why invest in covered call ETFs? He mentions that he owns several covered call ETFs, but he's rethinking his strategy moving forward because none of the ETFs match the total returns of the underlying assets. Now, we did speak before about how mechanically they're not supposed to match the returns of the underlying assets, but let's skip that for a second. He went on, if the ETFs cannot match the total returns of the underlying assets with dividend reinvestment, it's likely that they're going to underperform if dividends are taken as income. So why not invest directly in the underlying assets and sell shares as needed to generate income, is his question. And it seems like it's more of a statement, to be honest with you. So let's address this. So of course, a covered call ETF is going to trail the underlying assets in a powerful bull market because it's deliberately selling part of that potential upside to create that substantial income for you today. Now, selling shares is not identical because when you sell shares, you're permanently reducing the number of shares you own and must decide when to sell them. An income ETF systemically monetizes option premiums while allowing you to keep your share count, unless of course you choose otherwise. Also, some distributions may receive return of capital treatment, and this can defer taxes by reducing your cost basis rather than creating an immediate taxable event. So the choice is not good return versus bad return, it's maximum future growth versus higher usable income today, and those are different objectives. If you want to learn more about income ETFs, I made a video that basically breaks it down into 7 types. Take a look at the video here. Thanks so much for watching. I'll see you on the next episode.